This video is brought to you by 4 free stocks you can get with Webull. Deposit $100, get 4 free stocks worth up to $1,600, and get life insurance in as little as 5 minutes. Both of these links down below. Hey everyone, me Kevin here. The Treasury Department just pulled the rug out from under the Federal Reserve, and the Fed is pissed. In this video, I'm going to explain exactly what happened, what was expected, the reality of the situation based on some inside knowledge, you'll want to stay for that, and the impact this has on markets and stimulus negotiations. All right, folks, quick reminder as well to check out the amazing courses linked down below. A ton of you are emailing me for bundle coupons. This is a really good sign to me that a lot of you buy one course and then you want to upgrade to having multiple courses. I really appreciate that. Thank you. You can email me at kevin@meetkevin.com, and if you haven't checked yet, check them out with the links down below. We got the Black Friday month sale going on. So here's what happened. On Thursday evening, the Treasury Department announced they would reject extending 5 of the Federal Reserve's bailout programs. And the Fed is pissed off about this because they feel like somebody is coming up and unclipping their tool belt, because they always call all the tools they have tools in their tool belt, and that one day they'll put them away, but not yet. That's a quote from Jerome Powell. But now Jerome Powell's begrudgingly taking that tool belt off and going, fine, here it is, I'll give it back to you. Jerome's not very happy about this, but should we be worried? Well, let's talk. So most of these 5 facilities that are going to expire on December 31st have to do with bonds. Well, 4 of them do. We'll talk about the other one in just a moment. 4 of them have to do with bonds. And here's a quick primer on that, because when we hear that, it's like, okay, all right, you're losing me. Yeah, you're losing me. Give me my 4 free stocks, I'm getting out of here. Let's make this really simple. Let's say, it's important for the market. Let's say you want to raise money, and it's important for stimulus. Let's say you want to raise money. You've got a business and you're like, crap, I need 50 grand to get through the next 5 months of business. Otherwise, I'm going to go bankrupt. So to oversimplify this, you could post a notice on your website saying, hey, I'm selling 50 $1,000 loans, AKA bonds, and I'll pay you 4% interest. So basically 50 people buy your bonds, and all of a sudden you have 50 grand and you're paying 4% interest, but you got the money that you needed so that you could survive. Basically, you got a 50K loan at 4%. And as you know, this works as long as people actually take your loan, they buy your bond. Well, back in March, no freaking soul was buying anybody else's junk. Literally no one. Everyone's like, dude, I need the cash myself. There's no way I'm lending you 4% or anything for 4%. You ain't getting nothing. So instead, companies had to raise the interest rate they were offering. Carnival Cruise Lines, for example, was like, hey, y'all, we need some money. And everybody's like, y'all sinking. So Carnival Cruise Lines like, what if we pay you 11 to 13%? And what happens? The sharks come out. Literally, the loan sharks come out and they're like, did you say 11 to 13%? Yeah, we'll take that. Nosebleed interest rates, the people making the loans are making them bank, and Carnival survives. That's an example of how the free market works when it comes to financing risky operations, like sinking ships. Well, enter the Federal Reserve. The Federal Reserve decided, you know what, we can't have every company pay these nosebleed interest rates because that's going to tank the market. Everybody's going to hoard their cash. Credit is going to freeze up. Banks are going to be like, no, I'm not doing any loans at all. And then people won't have money to buy bonds, and basically the velocity of money goes down, and basically really bad things happen. So the Fed comes in and says, fear not, we will buy your garbage so you have some cash. And you know what? You could even give us the lower interest rate, because why do we care about making money? Taxpayers in 10 years are going to bail us out anyway. Anyway, that gets political. So the Fed basically injects money where no one else wants to. So think about this. Go back to March 23rd, bottom of the market. You put up a thing on your website that's like, I need a $50,000 loan. Again, I'm oversimplifying because really only larger businesses do this. But you put up your 50K and you're like, oh God, nobody's coming to bail me out. The Fed comes in, fear not, here's your 50 grand, we'll buy your crappy loans, in which the Fed does. You end up with 50K of more money now that can circulate in the economy. And most of this money is just straight up from the money printer. The Fed's like, don't worry, we'll lend money to you because we're just cranking it out on the printer. Now, they're not actually printing the money, they're just changing digits on a spreadsheet, but this is just sort of to depict what's actually happening. The principle is the same. All right, so now these loans, they're supposed to be paid back, right? But in an emergency time, people need the money now, and a lot of people are concerned that, hey, I'm not doing loans, like banks basically, I'm not doing loans, we're in a crisis, no way. So the Fed comes in and handles this. And the Fed is really funny about this. The Fed basically can use 10x leverage to lend money. Yeah, so this is where our whole economic system just gets really funny. So the Treasury Department takes a $10 bill and goes, ooh, the market's doing really bad right now. We're just going to take this $10. Oh, we'll put it in the bucket. We're probably going to lose it. And they drop the $10 in the bucket. The Fed is like, we got a $10 down payment. Hey, roll another $90 off the printer. They print another $90 off. So this is how they could really 10x their leverage. Now, the Fed has $100 that they can lend to people. So basically, when the Fed has $454 billion given to them by the Treasury Department, the Fed can really lend over $4 trillion. So take a pause there. That's a lot of the background in terms of what's going on, right? But take a pause there for a moment. The Treasury authorizes $454 billion for a bailout program. The Fed is like, we can add a zero to this. We've got over $4 trillion of bailout money. Who wants us to buy some bonds? We're ready to go on a shopping spree. And that shopping spree was designed, or I should say disguised, via a 5-program credit facility system. And all 5 of these programs, I mean, there were 13 in total, but 5 of them that are making the news have been rejected. That is, they will no longer be in existence. Let's talk about what those 5 are and what the impacts of those are. Okay, the first was the Municipal Bond Buying Fund. This basically helps cities raise money. So remember the example of posting, I need money on your website? Just think about cities doing that. And basically the Fed's like, hey, cities, if you can't raise money, we'll swoop in, we'll buy your bonds. And that way you guys have money to survive. The second and third were the primary and secondary credit facilities for corporations. These are 2 programs designed to allow corporations to sell bonds to the open market, and if the open market doesn't buy it, the Fed swoops in and buys it. So basically, this is the corporate bailout we heard about. This is when we heard about, oh my gosh, the Fed is propping up the stock market. Why? Because it allows corporations, these facilities allow corporations like Apple, Microsoft, Walgreens, and a ton of other companies to sell their bonds on the market, and the Fed just comes in and buys them at really cheap interest rates. Now, when these programs, all of these programs have been ended, and so a lot of people are like, oh my gosh, the stock market bailout has ended. This has got to be really, really bad. And it makes sense to think that. We'll talk about that more in a moment, but even though the Fed didn't buy stocks directly, when corporations like Walgreens and Apple can raise money by selling bonds to the Fed, it basically gives corporations more money, which means the stock market is buying shares of companies that have more cash, and more cash in a pandemic means those companies are safer. Well, the Fed just pulled the rug out from under that. The Fed's not doing that anymore. And so we're going to talk about the impacts of this in a moment. Basically, the big corporate bailout from the Fed, the stock market bailout, that's over. Okay, the fourth, so we've talked about municipal, the primary and secondary corporate credit facilities. Now they've got something called the TALF, Term Asset-Backed Securities. I don't think anybody really cares about the name. Basically, this was a facility to backstop loans for credit cards, small business loans, student loans, and auto loans. The purpose here is really to prevent banks from freezing up, right? Kind of like we said earlier, banks are like, no, I'm not issuing any new debt, screw that. You want a new credit card? Denied. This helps banks stay providing liquidity or keep providing liquidity. And that's really important for the market because look, you're running a business and you're like, crap, I need to finance the next 3 months worth of expenses, otherwise I'm going bankrupt, and no bank is lending you money. Well, that's bad, right? Well, that program is also now gone. So it's like, wait a minute, Kevin, this isn't sounding good. Like, all of these programs that seem like they have really good, important purposes are gone. Like, who doesn't want the stock market propped up? Let's be real. Maybe people who don't own stocks, but if you own stocks, you want the stock market propped up. You also want cities not to go bankrupt, and you want to be able to get credit where credit is needed. Okay, the fifth was the Main Street Lending Program, aka super cheap 5-year loans for small and medium-sized businesses. This program was also closed. And I mean, that seems really bad, right? I mean, all of these individually seem important, but you also have Democrats and like the New York Times freaking out. And this is not me taking a political stance. I'm just literally calling it like it is. The New York Times is freaking out and Democrats are freaking out. They're like, oh my gosh, you ended a loan program for small and medium-sized businesses? What the hell? Well, let's put politics aside and understand what the heck is actually happening. So, we explained what these programs are, how they actually work. If you made it this far already, you better have already gotten your life insurance and your 4 free stocks with Webull, and you better check out the courses because you are a pro for making it this far. Okay, now we're gonna get into the implications of this for the stock market and stimulus. So, consider this. What happens if you say, hey, it's November, I need to raise another 50 grand of money. I'm gonna sell some bonds at 4%. You post them on your website, boom, they instantly sell. That's good, right? That means you didn't have to raise the interest rate you were offering like the sinking ship of Carnival Cruise Lines. And it means, well, basically, you didn't need the Fed. The market worked. You didn't need the Fed to come bail you out. Well, this is kind of exactly what's happening. Markets are working again. Banks are lending. Cities are able to raise money by selling their bonds to the public. And corporations are getting their bonds sold to the public. So it's kind of like the Federal Reserve is the pit boss at the casino. Hey, everyone all right over here? All right, you be good now. Like, we all know the pit boss is loaded with dough. He could snap his finger and bring in a cart of new chips. New dough, basically. But everyone's happy at the tables. Everyone's working. The dealers are happy. The customers are happy. Corporations are happy. Cities are happy. Businesses are like, there are a lot of people. The market is happy. Now, this is not to be confused with people struggling in the market. I mean, just because we're using this casino analogy, let's go with this. People might be happy because the market is functioning, like the casino is functioning. People aren't throwing chips everywhere and trying to steal chips from everyone else. That doesn't mean that people aren't losing money like crazy. That doesn't mean that people aren't struggling, and it doesn't mean that businesses aren't struggling. You know, we just had a guy who lost $1 million on blackjack, just as an example, right? Like, people are losing money. There are businesses failing. There's struggling happening. But the market itself is functioning. The casino, for this analogy, is operating. And see, that's what's happening here. According to Treasury Secretary Mnuchin, of the $454 billion authorized, which basically gets ballooned to just over $4 trillion, only $25 billion have actually been used. So $450 billion pot, $25 billion have been used. And remember, $25 billion gets multiplied by 10x, right? Because the Fed's 10xing their leverage. So that's about $250 billion out of that $4 trillion that's actually been used. It's a drop in the bucket. In fact, here's a sheet that shows you the money that's been used on these programs. All of these figures here, just assume these are billions. So think 65 billion, 2 billion, 5 billion, 57 billion, 45 billion. The point is, this does not add up to $4 trillion. It's way, way less. AKA, these programs aren't being used as much as we thought they would be getting used. So this is kind of why you've got Treasury Secretary Mnuchin going, hey, you know, the markets are doing fine without these programs. In fact, here is Treasury Secretary Mnuchin's statement. Right here at the bottom, you could see currently approximately 25 billion of loans and other assets have been funded, and they have way more capacity. And then over here on this page, you'll actually see right here on this corporate section, corporate bond markets basically functioning totally normally. I'm bottom lining this whole section here. Like, there's no need for the Fed to bail corporations out anymore with these bonds. Municipal credit facilities, no bailout needed. TALF, well, the liquidity position and capital position of U.S. banks ensure they can fulfill the financing requirements of their customers, AKA, all of these functions are operating. The 2 facilities over here aren't needed. The 1 facility over here isn't needed. The 1 facility over here isn't needed. Okay, so basically, Mnuchin's like, dude, just give us the money back. Like, we don't need to have this $450 billion allocated to the Fed anymore because it's not necessary to keep things functioning. But wait a minute. That everyone is talking about the Main Street lending program because that's the buzzword. Basically, the Fed pulled out the blanket from small and medium-sized businesses, or pulled out the rug from under small and medium-sized businesses. How could they? That is so terrible. Small and medium-sized businesses, the market might be functioning, but people are losing their pants and people are struggling and businesses need help. All right. Well, so this is where a little bit of inside knowledge helps. I personally applied for a Main Street loan, not because I need the money, but because I want to make these YouTube videos and understand what the heck is going on, so that way when I'm investing in the market and I'm talking to my course members in my private live stream, I can actually provide insights that, in my opinion, make total sense. And that's why I'm able to make videos like this, because I get the insights. I care about this stuff. This is why I work 12 to 14-hour days, because I love this stuff and I like knowing this stuff. So here's the scoop. I was told by 4 different banks the following. Each Main Street loan costs the bank at least 50 grand in legal fees alone to get approved. This means these loans are rarely given to small businesses because the loans have to be like $3 to $4 to $5 million at minimum. No small business is going, yeah, sign me up for $3-4 million of debt that I have to pay back in 5 years in a balloon payment. Most small businesses don't have the capacity to take these kinds of loans. And even if the businesses had the capacity to take these loans, guess what? Problem number 2, it's a big one. Even if banks decided to do these smaller loans, banks underwrite, or basically verify that the loans are going to be good, loans in such a way so that the bank doesn't lose money. This makes sense. Like, if you're going to give a loan, the bank doesn't want to lose money, right? The Treasury Department said that banks have to be on the hook for 5% of the loan. So if they do $1 million loan, the bank is on the hook for $50,000, which is potentially what they spent in legal fees. So they're potentially doubly exposed. Now, they collect some fees as well from the customer, but still, the bank doesn't want to lose money. That's the short of it. The bank's like, dude, we will not lose money. So guess what the banks say? The banks say, hey, we realize the Federal Reserve says you can get a Main Street loan if you're struggling and potentially going to go bankrupt. You could get a Main Street loan as long as you promise that you're not going to go bankrupt for the next 90 days. But given that we, the banks, are on the hook for 5%, we're not really going to listen to those rules. We're going to make our own rules. They're allowed to do that. These are called overlays. The point is, the banks say, yeah, we're looking for companies. I got this from 4 companies, okay? From 4 banks. We're looking for businesses with high cash flow and high growth. And I'm like, wait. We're in a pandemic. Businesses are suffering. Businesses who need this money aren't companies with high cash flow and high growth. They're businesses with less cash flow and less growth because they need a bailout and they're suffering. How are banks supposed to have how are businesses supposed to have high cash flow and high growth to get a Main Street loan? And the bankers are like, yeah, this is kind of why we've been denying like 95% of the loan applications we've been getting for Main Street loans. AKA, the Main Street lending program is a complete, utter, and disastrous failure. It basically provides a cheap 5-year loan to rich companies that are already doing really well. It's not helping struggling companies, and banks are refusing to lend to struggling companies. The struggling companies are staying screwed. The Main Street lending program is just another rich person's bailout. That's it. The program was a failure. So you literally have a situation where the market doesn't need the Federal Reserve's bond bailouts anymore. And you're in a situation where, well, the Main Street lending program is basically just a setup to help rich people, and it's a disaster. Okay, so what are the implications of all of this on stocks and stimulus? Well, on stocks, nothing. The stock market doesn't care. The stock market shrugged this off because we don't need the pit boss right now. What about stimulus? Well, it's actually really good news for stimulus. Mnuchin is taking the $454 billion back and combining that with other unused CARES Act money that provides around $600 billion of money that can be reappropriated for a new stimulus deal. This is basically a way of saying that if Congress comes up with a new $1 trillion deal, it's only going to cost us around $1.4 trillion. This, by the way, is basically making Republicans' mouths water because now they see stimulus possible for much less money. I mean, think about it. $1.4 trillion is substantially less than $2 trillion, right? So, all in all, when I bottom line all of this, and I know this is a long explanation, but many of you, especially in the course, have been asking for this detailed information. Is this good or is it bad? This is good. The market don't need the money for the pit boss right now. And if the market did, Congress could always try to, reallocate something. But right now, it's just not needed. Now, would it have been better to have just left it there for a little bit? Maybe they could have left it there, but I really think Mnuchin's like, well, just give us this money for now, because right now there are other priorities we could use this money for, like bailing out restaurants that are struggling or doing PPP loans and things like that. So to me, this isn't all bad. In fact, this is much more good than it is bad. So if you like my perspectives, make sure to check out the courses. If you find any people that say this is really bad, make sure to share this video with them just to share this perspective. Get your 4 free stocks, get your life insurance, and folks, we'll see you in the next video.